Please welcome to the stage Min Jung Kim, the Barbara B. Taylor Director of the St. Louis Art Museum.
Thank you. Good morning, everyone. I am Min Jung Kim, and I am the Barbara B. Taylor Director of the St. Louis Art Museum. And it is my great pleasure to welcome you here today for a conversation with James Bullard, President and CEO of the Federal Reserve Bank of St. Louis, presented by the Greater St. Louis Incorporated. Now, many of you may or may not know, but I am new to St. Louis and to this museum, having just arrived 6 months ago. But in that short time, I have gotten to know the transformative work of Greater St. Louis Incorporated and its member organizations. And I have been inspired and impressed by your collaborative approach to fostering inclusive economic growth in our region. The St. Louis Art Museum is a partner in those efforts as a pillar cultural institution that has offered free general admissions for more than a century, and that holds a diverse and a growing collection of works donated by and for our community. The museum is proud to indeed be St. Louis made. It is now my honor to introduce a community leader who has helped to sustain the museum as a cultural cornerstone where millions of St. Louisans have made a lifetime of memories. Please join me in welcoming Andy Taylor, Executive Chairman of Enterprise Holdings and Founding Chair of Greater St. Louis Incorporated.
Welcome, everybody. We've got a very, very good turnout today. Min, thank you for that very nice introduction. She's been fantastic. She moved here to town with her son, and who's at MICDS, and he's doing great. And anyway, we're very happy to have one of St. Louis's crown jewels here at the Art Museum in her hands, because she's going to do a fantastic job. I also want to thank all of you who are supporting the Greater St. Louis effort, and we've had sensational support here in our second year, and so that is very, very inspiring to us that are working every day at Greater St. Louis. Today we have a special opportunity to hear from Jim Bullard, who I think many of you know. I think he's a total asset to have the bank here and have Jim running the bank over the long term, and the timing for this meeting is very, very good. Sad in some regards, but it's very good that we're having this meeting this morning. But Bill Bullard helps set the direction of the U.S. monetary policy while overseeing the Federal Reserve's 8th District, which includes branches in Little Rock, Louisville, and Memphis. He is also an honorary professor at Washington University, and I always like to see Jim or hear Jim because he makes things relatively simple, and he also has a marvelous sense of humor, and I hope that we will all see that marvelous sense of humor. And he's been very, very good to the community. He's been involved with United Way and other efforts here. Our timing here for this meeting is really terrific. And we'll have a Jim talk, and then we'll have a special fireside chat that will be monitored by my friend Penny Pennington, the managing partner of Edward Jones. And Penny is also a member of the board of directors for the Federal Reserve Bank and an executive level founder of Greater St. Louis. So there's a lot going on these days, and I think the timing again for this meeting is terrific. We're really looking forward to hearing what Jim has to say, so thank you. Jim?
Thank you, Andy, and thanks to the St. Louis Art Museum for hosting today, and thanks to Greater St. Louis for putting on this event. I'm really looking forward to rousing discussion here. So I'll start off with my remarks, and then we'll go to the fireside chat here in just a moment. It's a pleasure to be here. It's a pleasure to see people in person. And I think lots happening in the U.S. economy. So it's great to be here today. So I called this Removing Monetary Policy Accommodation. And I just wanted to level set people on where I think we're at in the U.S. with respect to monetary policy, and then that'll facilitate our discussion here going after my remarks. So the key themes here are that the U.S. real economy has more than fully recovered from the pandemic recession. And just to keep in mind, the recession ended 2 years ago now, almost. So we're really quite a ways out. I think, mentally that's been hard because the pandemic itself not quite over. But as far as the economy is concerned, the pandemic recession was over quite a while ago. The economy is also expected to grow faster than its long-term potential growth rate, and I think that's something to keep in mind. There's not much dispute about that, although we could argue about it a little bit today. There are risks to the upside and the downside, and we'll talk about that. And then with respect to inflation, as I'm sure many of you are aware, inflation is running well above target by any measure. It's not really a matter of measurement. You can't point to one way to do it or another way to do it. Inflation is high. It's way above our target. So we'll talk about that a little bit. And then monetary policy itself is still set for peak policy accommodation. We've still got the policy rate close to zero, and the balance sheet of the Fed has increased to nearly $9 trillion. So you've got to get used to central banking here. That's trillion with a T. And so this policy is putting upward pressure on inflation in an environment where we have a lot of inflation already. So I think the case is pretty clear that this situation calls for rapid withdrawal of policy accommodation in order to preserve the best chance for a long and durable expansion, which is what we all want. We want to stay out of recession for many years to come. So let's start with the idea that the economy has more than fully recovered. We're actually in the expansion phase of the business cycle, with national income higher than it was at its previous peak. You can look at personal consumption expenditures, which are what households consume. That's even surpassed the trend line that you would have drawn from 2011. So in many ways, at least in terms of consumption, we're doing better than we would have done had there been no pandemic at all, and I was giving you this talk today. So we're actually above that level. So here's some pictures. Pictures are worth 1,000 words. Maybe this one isn't, I don't know. But the blue line here is real GDP in levels. It helps to look at the levels because the pandemic recession was so deep. And there you see the recession in the middle of the picture there. And then there was a recovery phase. But recovery is usually defined as the point at which you get above the previous peak. And we've been above that for a while now, as you can see by the horizontal green line there. And then if you look at the gold dotted line, that's the trend line drawn from 2011. So we're almost on that trend line and about to head higher above that trend line. So really, in macroeconomic terms, we've recovered very quickly. We're in the expansion phase, well above the previous peak in terms of national income. And the same is true for personal consumption expenditures. This is the same picture. The blue line is real PCE. And again, we're way above the previous peak in consumption expenditures, and we're actually above the trend line that would have been drawn from 2011. So I think, again, I guess my point here is that the pandemic's still going on, and so people think that the economy is tracking the pandemic one for one. That isn't true at all. I think mentally, a lot of people are thinking we're in the gray area, the dark gray area there, or maybe one or two dots to the right there. But that isn't where we are. We're actually above the pre-pandemic trend. So the economy has shown tremendous resilience here. Things have moved far faster than they did after the 2007 to 2009 global financial crisis. And it kind of all makes sense. This is more like a natural disaster. You had the big natural disaster, and usually after natural disasters, you get fast recoveries and you're back on the expansion path fairly quickly, and that's what has occurred here. So I think the mind shift to where the economy is as opposed to where the pandemic is an important one to keep in mind here. But not only are we in the expansion phase, but GDP is poised to continue to grow at an above-trend rate. Now, a lot of people focus on the idea that, well, last year was a banner year for GDP growth. This year probably won't be as fast. Okay, but it's still going to be faster than the potential growth rate of the U.S. economy, and likely at a pace that was only a few years ago was considered unattainable by the U.S. economy, 3 or 3.5% or 4% growth. And then that's feeding over to labor markets, and I think almost all metrics of labor markets are very robust, and they're likely to continue to improve all through 2022 as we get further reopening in the U.S. Economy. So this is just to reinforce this point. The top panel in this table lists some possible real GDP growth in 2022, this year. And they're like 3 to 4%. I think a lot of Wall Street is 3.5 or 4%. Depends who you talk to. Things are moving rapidly. You've got geopolitical tensions here, but basically my point is that the potential growth rates, which are listed in the bottom half of this table, they're all 2% or 1.75% or something like that. So basically the economy is probably going to grow quite a bit faster than normal in 2022. So that's going to put additional pressure on labor markets and you'll see continued labor market improvement going forward. Now, of course, there are risks to the growth forecast, and with the war in Ukraine, that's dominating headlines now, as it should, and we'll have to monitor that very closely. But I just have a couple of comments about it. Of course, there's a lot of risk, and we don't all know exactly what's going to happen, but some basics we might be able to speculate on. One is that the impact on Europe is going to be more direct than the impact on the U.S. The U.S. has relatively few direct ties to Ukraine. A lot of people this morning and in recent days have been talking about global energy markets. They are certainly being impacted over the short to medium term. A lot of that is sort of an implicit boycott of Russian oil. On the other hand, the U.S. in recent years has at points been the leading producer of oil and other commodities, and so we may see increased U.S. production coming out of this at high prices, and that would help the U.S. economy. This is why oil shocks have actually been harder to interpret in recent years compared to what you may have been used to thinking about them in the 70s or the 80s. This isn't the 70s or the 80s anymore. U.S. is less energy intensive than it once was, and now we're a producer, not a net producer, not a net consumer, depending on exactly where you look at the data. So it's not clear what the macro implications are of disturbances in global energy markets. And finally, the Omicron wave of the pandemic appears to be fading. Cases are down dramatically, confirmed cases are down dramatically in the U.S. Deaths are also falling, and that's suggesting that there'll be a further reopening of the U.S. economy, especially in the second quarter of this year and the third quarter of this year. So we've achieved what was in those first graphs with part of the economy still shut down or still struggling with the pandemic. But if the pandemic continues to fade here, which is certainly what it looks like, as a base case anyway, you would expect further reopening and further boom in the U.S. economy. So let me go to labor market conditions and just argue that I think labor market conditions are the best they have been in years. For those of you that are running businesses in the room here, this is very distressing because it's very hard to hire workers and hard to retain workers in this environment. Lots of churn in labor markets, and good for them. They're trying to get the best job, the best match that they can get, given their skills, and so you've got a lot going on in labor markets. This is a labor market conditions index calculated across the state by our sister bank in Kansas City, and this particular index takes all kinds of labor market indicators and crushes them together to just get one number that summarizes the totality of the information we have on U.S. labor markets. And you can see in this picture the global financial crisis in the gray on the left there, a much bigger event than the pandemic, longer event than the pandemic recession, which is the gray area in the right part of this graph. And after the global financial crisis, it took forever, well, forever is a long time, but it took all the way till 2016 till this labor market conditions index came back to normal, which is 0 on this index level. But this time, that isn't what happened at all. Instead, you had the pandemic recession there in March and April of 2020, and we've been recovering ever since. And now the labor market performance measure is actually above the pre-pandemic level. And if you look way over to the left of part of this chart, it's above the level where it was before 2006, in 2006, 2007, which was another peak in business cycles. And in fact, you'd have to extend this all the way back to the late 1990s to get a better number on labor market conditions than we have today. The late 1990s is kind of the gold standard of the labor market. It was considered the very best labor market that we saw in the whole post-war era. So you're seeing really one of the best labor markets, and I've just laid out an indicator that, or an argument in the first couple of slides that this is going to continue to get better in 2022, and this number will go even higher as we go forward. I guess we have a jobs report tomorrow, so we'll get a little bit more information on where we are. But ADP, I don't know if you guys saw it this morning, is pretty strong. Hopefully we'll get another good jobs report tomorrow. This is another chart that people have been looking for on state of the labor market. This is how many job openings are there relative to unemployed people, and right now there's about 4.6 million more job openings than unemployed people, and so the unemployed per vacancy ratio has gone down to the very lowest level that we've seen in the last 20 years, and probably well beyond that. I don't think there is data beyond the late 1990s on this, but one of the very best that we've ever seen on this dimension as well. And you can see again how this came down really rapidly after the pandemic recession peak, where unemployment was 14.7% on the official measure, right at the time of the pandemic, initial phase of the pandemic. So this is not, I guess, this picture and the other pictures are meant to reinforce the idea that this is not the same as this period between 2009 and 2019, which you can see in this graph. That period had super slow and almost molasses-like movements, and it took forever to get to a really strong labor market. That isn't what happened here. This all happened in a matter of 2 years, and not only that, but we're at actually lower levels on this metric than we've ever seen. I know this is painful for some of you if you're on the side of the market, and me, where we're trying to hire people, because it's hard to do and retain people, but that's what we get paid the big bucks to do, right? So let's talk about inflation then. Inflation has, maybe it's an understatement to say it's surprised to the upside. PC headline inflation, this is the one that the Fed says that we want to track and meet our inflation target on this measure, it's currently 6.1% against our inflation target of 2%. So we're way off on headline PC inflation. If you don't want to count the energy component or the food component of that, which isn't really fair because people have to pay those prices, but okay. If we want to kind of get a little bit less noisy measure of inflation, then core PC inflation throws out the food and energy components. That number is 5.2% from 1 year ago, so we'd still be more than 300 basis points above our inflation target on that measure. There are other measures of inflation, but it doesn't really matter how you look at this picture. It's just a lot of inflation in the U.S. economy. Headline CPI inflation, consumer price index inflation, is running at 7.5% from 1 year ago. So this is just way too much inflation, highest inflation in nearly 40 years. That was the Volcker era. And I would also stress that this is the same amount of inflation that you would have seen in a period like late 1973, early 1974. So people say, well, it's not the 70s. Well, it kind of is the 70s. You're in the middle of, you've got numbers that you would have seen in the middle of that decade on inflation. So this is a serious issue. It is the Fed's responsibility to control inflation, and Fed credibility is on the line here. And I'd also stress that inflation's especially hard on low and moderate income households, because for many households, wage gains have not kept up with inflation. Sure, you know, if you're maybe a frontline worker, maybe you did find a job where you got a higher nominal wage, but unless you got 7.5% or more, a 10% raise or something like that, your real income actually fell. So the problem is real wages are falling in the U.S., and this is actually something that's super tangible to the average household. They can see that the prices they have to pay are going up and their wages aren't keeping pace. And this is why people are mad about this and why inflation is such a scourge for the U.S. economy and global economy. So this is just a picture that says the same things I've been saying. As you can see, before the pandemic, we did talk a lot about inflation. We talked about inflation being below target a lot of the time in 2017, 2019 there, both headline and core. That was a preoccupation of the Fed at the time. The pandemic comes along, inflation does fall but recovers. But really, since in the last year or so, it's really that period where inflation has really exploded. And now we're missing, based on what I've been saying, by, you know, depends which metric you use, but you're missing by a ton to the high side here. Just to accent that this has been a surprise and defend the Open Market Committee a little bit, if I was giving this talk a year ago, none of this evidence would have been apparent. Even 1 year ago, I would have been able to come here and say, no, I think we're basically hitting our 2% target. So it's really just in the last year that this has really come up quite fast, and just shows you how fast things are moving. And that's all tied to the fact that the recovery and expansion has been much more than what people had previously appreciated. So last December, the committee, including me, said that we thought inflation would be right around 2%, and so we missed by a mile on that. So that's the inflation surprise. Now, what's the initial response? So my point here is, it looks like we're doing nothing, but no, we're actually doing something. So let me make that argument. At the time of the pandemic recession, we did move the policy rate to near zero. We started outright purchases of Treasury securities and MBS. That was the so-called quantitative easing. And those settings remain intact today. So this is putting upward pressure on inflation, actually now exacerbating the inflation problem. So we haven't really changed our settings all that much, although the committee has agreed to phase out asset purchases by mid-March, so just weeks away now. And public commentary by members of the committee and participants on the committee has suggested that more policy rate increases are in train for 2022 than previously anticipated. So in the miracle of financial markets, which are incredibly forward-looking, that's actually had an impact on financial market pricing before the Fed has actually done anything. So it looks like we've just been asleep here. We're not completely asleep. 2-year and 5-year Treasury yields have increased about 100 basis points. So here's a picture, just one picture that shows you the monetary policy stance. There's the pandemic recession there, the gray area in the middle, and the Fed funds effective rate plunged all the way down to near zero. That's the left-hand graph and the blue line, or left-hand axis and the blue line there. We're still there, effectively at zero on the policy rate. And then on the right side, we have trillions of dollars. That's the size of the balance sheet, and it went up a lot during the pandemic recession itself and continued to increase to almost $9 trillion today. So this is the sense that the gold line is still going up and the blue line is still at zero. So that's the sense at which we haven't done anything. But if you look at the market pricing since last October, particularly when the chair and the committee made the decision to speed up the tapering of asset purchases, since then market pricing has moved up. So the 2-year Treasury yield is the gold line here, and the 5-year is the blue line, and those are both up about 100 basis points since early October. So in some sense, there has been tightening of financial conditions. So we have, in this sense, moved off zero, and that's helping us maintain our policy of keeping inflation under control. However, this is market pricing. We actually haven't moved our policy instruments yet. So the next steps would be to follow through with the policy rate increase and balance sheet runoff. If we don't do that, I think now we'd risk squandering policy credibility. And in addition, I think given how fast events are moving, we have to be prepared to move even more aggressively going forward if inflation continues to increase, or even if it does moderate, it may not moderate as much as expected, and we have to be in a position to act more aggressively in those circumstances. So let me conclude here, and I hope this is done to sort of level set the conversation here. First of all, inflation has surprised substantially to the upside in an environment where real economic activity and labor market performance are expected to remain robust, even acknowledging the geopolitical risks that are very apparent in today's headlines. There's been an implicit initial monetary policy response to the ongoing inflation shock, and that's reflected in financial market pricing, but the committee now has to follow through with policy rate increases and balance sheet runoff, or risk squandering policy credibility for our 2% inflation target. So I think forthright and transparent actions designed to keep inflation under control will give the U.S. economy the best possible chance at a long and durable expansion. So let me stop there. You've been very patient. I'm looking forward to the discussion here in just a minute. So thank you.
Ladies and gentlemen, please welcome to the stage Penny Pennington, Managing Partner at Edward Jones.
Good morning. Jim, thank you. That was terrific. You always put things in perspective, and we're in a unique moment in time in history. So we're going to go a little bit deeper on some of the things that you were just sharing with us. We're going to start global, and then we're going to come back local. So
okay.
Let's start global with Ukraine. And you mentioned it. I'm also seeing some blue and yellow in the room today, which is really special. So as you said, we're expecting short-term increases in energy. We're seeing volatility in the markets. Jay Powell is going to say this week the implications for the U.S. economy are highly uncertain, and our economy evolves in unexpected ways during times like this. So can you project or help us think about some of the longer-term impacts and what this might mean for monetary policy in the near term?
Yeah, I think the most sensible thing to say is that we don't know any better than anyone else knows exactly how the war will progress, what will happen, whether there'd be some kind of resolution, whether it would drag on for a very long time. All those things are up in the air at this point. So there's just risk out there, and markets are going to have to price that risk. I did give a couple of arguments that there are some silver linings, I think, for the U.S. U.S. oil production, maybe a question mark over that, but certainly has been very strong in the past and could be strong again. I could see a bifurcated oil market where Russian oil sells at a discount. As an economist, I'm skeptical of the idea that they can't sell the oil to anybody. I think they probably can sell it to someone at a discount and still be profitable, even given where the prices are today. But it would take time to sort out some kind of reallocation of those resources. They do have a ally or quasi-ally in China that needs commodity resources. So it does seem like there could be a reordering of the global oil market. And I think it's harder to interpret energy, as I said in the talk, it's harder to interpret the energy shock compared to what you would have said in the 70s or the 80s. Energy intensity in the US is only 40% of what it would have been years ago. And now we've got all this production in the US, and actually at some points we've been oil exporters. So it does seem like there's kind of a question mark around what the real impact would be on the US economy. Individual companies or individual corporations may have, may be highly impacted, but as the economy as a whole, I think it's hard to come to a firm conclusion. I think the major risk here that markets are pricing in totally appropriately is if there would be a wider war or NATO would be drawn into the war. And I think that just remains an open question here, and I don't know any more than anyone else knows about that.
So we talked about Ukraine, you talked about COVID in your talk, and the shorter and longer term implications of COVID. We're seeing short-term issues with inflation, with supply chain. How do you think that's going to play out in the longer term, and what does it mean for monetary policy in the shorter term?
Well, I'm hopeful that, and I think we all are, that COVID is going to come to a close, at least in the US and Europe. If you look at the EU numbers and I like to compare the European Union to the US because the size of the populations are kind of similar and the size of the economies are kind of similar. But the confirmed cases are falling rapidly in both places, and hospitalizations and ICU and other measures are also falling. So it does look like Omicron is playing out the way it was expected to play out, and the way it played out in South Africa, which is that because it's so transmissible, you were going to get many, many cases, many of them probably not even accounted for. But on the other hand, it was also going to burn out quite quickly, which seems to be happening. So this pandemic has already thrown us at least 2 curveballs, so maybe this will be the 3rd curveball, and we'll have strike 3 here. But I hope not. I think we're coming to a close here, and I also think the U.S. population has adapted to the fact that we have this new disease with us. We do have ways to handle it. The vaccines have held up with boosters fairly well to the Omicron variant. And we've got therapeutics coming online and other treatments. So I don't think this probably not completely go away. You'd still have some residual, deaths, but greatly reduced from where they have been at the various peaks that we've experienced. So I do think this is going to come to a close. So for the economy, what this means is that you'd have the residual reopening occurring. You'd have additional reopening of things like do major event at the art museum, which you wouldn't have done even 30 days ago probably, but you'll see much more of this across the whole economy, and in that sense I think that will just feed into the idea that you'll probably get 3.5% to 4% real GDP growth this year in the U.S. economy.
So you and I have talked about inflation at our board meetings as it relates to Edward Jones and the fact that we serve 7 million clients across North America, and we sit down with them every day and talk to them about what's happening in the economy and how that affects them. And as I've said to you, they have 3 questions: inflation, inflation, inflation. Some of them remember inflation. You mentioned this in your remarks. Some of them have only read about it in books. So it's impacting confidence right now. You mentioned, I love it, that you used the word credibility a couple of times. The Fed's credibility as an inflation fighter seems to be very strong because the Fed doesn't have to do anything right now, and the financial markets seem to be responding. I think that's a very positive thing. I'm not going to ask you what's going to happen in 2 weeks at the FOMC. But I will ask you a slightly different question. How can the business community think about this and work in this environment around consumer confidence as it relates to inflation in particular?
Yeah, I mean, as I said in my talk, I mean, it's very tangible to people. These are prices that you're paying and experiencing every day, and so it's not hidden at all. It's really something that hits us all in the face, and that's why there's been so much emphasis since the Volcker era to keep inflation low and stable, keep it under control. It does depend a lot on central bank credibility. It's been established in the literature and in practice that central banks are the primary controller of inflation, and that's why inflation targeting became popular globally in the 1990s and kind of swept the world and was very successful. The inflation rates all around the world came down and became centered on the various inflation targets of the various central banks around the world. Most of those are at 2%. It's become an international standard. And then what you have to do is take appropriate action at the appropriate time so that you keep inflation under control. That's the credibility part. And even though we haven't done anything, as you say, we have a lot of credibility, so markets have done our pricing for us already. But still, we're going to have to act here in order to maintain that credibility and make sure that we don't get into a period of multi-year high inflation. I'd say one other thing about this is that when inflation's this much above target, and we're experiencing it today, is that you're susceptible to other shocks. Other things might happen. Well, lo and behold, you got war in the Ukraine, other things that might happen that might drive inflation even higher. So being out of position on inflation puts you, kind of makes things worse when shocks come along, and that's exactly where we are today. So I think there are many things going on here, but you asked about the business reaction. I think as business leaders, we have to be sensitive to the prices people are paying. Their real incomes is very tangible to people. You have to think about how to attract and retain workers in this environment. There are many dimensions on which you can adjust. Flexibility is one that people like, that doesn't cost dollars directly, but on the other hand, they still have to buy things that are going up in price. So I think this is a major challenge for business leaders to operate in this environment.
Let's bring it home to St. Louis and this region a little bit. You mentioned we've got a sister bank in Kansas City. Our state is the only state in the Federal Reserve System that has 2 Federal Reserve banks. It's an important part of the world right here in the middle, and St. Louis is on the ascendancy again. So let's talk about inclusive economic growth. That's our North Star. That's the North Star of the STL 2030 jobs plan of Greater St. Louis, of the work that we're doing together as community builders and businesses. So what are some of the ways that we can work together to approach that kind of equitable economic opportunity and growth in our region? Yeah,
some of you know that I did a study of I guess it's about 5 years ago now, about real per capita income across metropolitan statistical areas in the United States. So let me just talk about that and see if this triggers anything for you. But it was revealing to me, and that's why I promoted it some at the time around town here. But there are at the time in that data set there were 53 MSAs in the U.S. That were above 1 million people, and St. Louis is one of those. They vary in size dramatically. That's something you have to keep in mind. New York, LA, Chicago, much bigger than most of the others. You have to think in terms of MSAs. MSAs are designed to talk about commuting patterns and who's working in an area. So they're designed to get the economy of the area and not to have artificial political borders influence your thinking. You should just be thinking about what's this particular economy. Lots of interesting stuff. And then what's interesting is that, the way I think about it as an economist, you should think about real per capita income. What is the median person in this particular MSA? How well do they do? That's the metric that you should think about. When we look at cross-country comparisons, that's the metric that we think about. When we say Switzerland's a rich place, that's what we mean. High per capita income. So it turned out in that study that the three of the highest, or of the top 10, let's say, highest per capita income MSAs, 3 were on the West Coast, 3 were on the East Coast, 4 were in the Midwest. That's because cost of living is lower in here, but you can't just have low cost of living. You have to have low cost of living combined with some really great jobs. And I think that's what St. Louis has together, because there's kind of a great business tradition, there's a great engineering kind of tradition, biotech, fintech today, other aspects that kind of bring together high quality jobs, relatively low cost of living, and then you end up beating all the other cities in real per capita income. So I think this is the way to think about this. When people talk about different cities, they have, in my mind, ridiculous comparison points that they shouldn't be talking about. They should be talking about this. On the West Coast, there's actually, it's undeniable that San Francisco and San Jose, 2 different MSAs that are next to each other, are just dominating, and they have high costs, but they also have super high per capita income. But that is tied up with what in the heck's going on in Silicon Valley? Are they going to take over the entire world? And the other place on the West Coast is Seattle, which has basically the same thing with Microsoft and Amazon being based there, and a kind of ecosystem around that. But in the Midwest, Minneapolis, St. Paul, St. Louis, Nashville, Tennessee, and Houston were winners in that particular study. And I think of those, I would point to Nashville, which has been a boomtown, as something to look at and something to consider for St. Louis. I'll stop there. If you want to see more on this, it is on my webpage. It's a little bit older now. I haven't updated that study, but I learned a lot from it. What's the poorest place in America in MSAs? It's Riverside, California, of the big MSAs, and other places that are often, considered places to copy. Atlanta, for instance, often gets high marks, but we're actually ahead of Atlanta on per capita income. So Dallas is a place that I thought would probably end up in the top 10. They didn't in that study. So it's not quite what you think it is. And that's why I thought this was important. It reorients your thinking about who's being successful and who maybe isn't being successful in the US, and you get away from the kind of noise that goes on between the natural competition between cities, and you get down to thinking about, well, what do we really want? We want the highest standard of living that we can possibly have, and how can we get to that? And I think the ideas that we've had about, in recent years, about creating an ecosystem of business development, startups, new ideas, new businesses, I think that fits well with the history of great business startups in St. Louis. Iconic industries have started here over the years. You can continue that process. Many of those won't succeed, but some will, and and those will be your leaders going forward. So I think this is a better way to think about local development, and I think is going to pay handsome dividends going forward.
I love everything that you just said. I love it, and I'm going to remember it because what you just shared was a narration of a current contemporary story about St. Louis and about our region and about what it has to offer. It's impossible, I guess, to quantify the standard of living in terms of the quality of life in a place like St. Louis. I mean, look where we are with a world-class museum and inside a world-class park, and there's so many other examples of that. So the narration of our story now is about innovation and about growth, about emerging sectors, about our competitive positioning against places like Nashville and Indianapolis. Any last word about what you would ask us as business leaders to do or think about as it relates to the work that you do, and ensuring that the narration of that story is our future as St. Louis?
Well, you just mentioned some places that often get high marks in this kind of discussion. So Indianapolis, I went to IU, by the way, so I'm a Hoosier, but Indianapolis often gets high marks, Atlanta often gets high marks, Pittsburgh often gets high marks. So St. Louis has higher standard of living than all those places. So you gotta get the idea that you're actually starting from a high position within this 53 MSAs, and could you go to top 5? I think would be something to think about. I don't know if you could beat San Francisco, San Jose because of the way the tech industry has evolved, but you're not that far, actually. St. Louis is not that far from penetrating the top 5. Now, maybe we need some success to move up, of course, but I think we've got the right strategy in creating the ecosystem, being able to attract people here from anywhere to work here, having iconic kinds of institutions like the St. Louis Fed, like Washington University, and many great businesses that we've had over the years. And I think understanding that businesses have life cycles, they will come and go, but you'll have new ones coming on. That helps a lot, I think, in thinking about how you're going to survive, thrive, and succeed over the next coming decades or the coming century.
Jim, thank you for putting it all in perspective. I am a proud member of the St. Louis Federal Reserve Board, and I just want to say thank you for your leadership. It is an iconic institution. It's one that serves our country and our citizens well. It's got a healthy culture and strong leadership, and that doesn't happen by accident. It turns out leadership really does matter. So thank you for your leadership. We appreciate you being here. Thanks to our audience. Great to be with you.
Thank you, Penny. Thank you.
Please welcome to the stage Jason Hall, Chief Executive Officer of Greater St. Louis, Inc.
All right, well, thank you everyone for joining us this morning. How about a round of applause for Jim Bullard and Penny Pennington? That was terrific. I hope you've enjoyed today's conversation and picked up some amazing insights. We're all facing these issues. This is a highly unusual time, I think, as you heard from Jim and Penny, and these insights help us navigate that and make the most of it. I thought it was also striking. I mean, you heard today, some of the great strengths we start from as a metro. You heard from Jim. We got to look past our political and geographic boundaries because the unit of competition in the global economy is our bi-state St. Louis metro. I think that's why many of you in this room formed Greater St. Louis Inc. last year, so we can do that easier and more effectively and bring home more wins. It was great to hear about leaning into those great industry strengths, geospatial, fintech, financial services, and the like. We've got those opportunities are there for the taking. The startup community. And when Jim was talking about the great tradition, I think I'd be remiss with our chairman, one of the great family-owned businesses in the United States with Enterprise Holdings, a very successful St. Louis startup. Penny and her partners now stewarding in Happy Birthday, a centennial, the 100-year of Edward Jones, a downtown St. Louis founded startup, now 100 years later with $2 trillion of trust and assets under management. That is an extraordinary level of success for St. Louis. And last week, we were together celebrating the NASCAR Cup Series is coming to our bi-state metro. And as Mike McMillan, the CEO of the Urban League of Metropolitan St. Louis, was introducing Dave Stewart and reminding us that St. Louis startup, the largest black-owned business in the United States and the most successful black-owned business in the history of this country, started right here in this metro. That's what we're capable of doing, and that's why we need to continue to look forward. I thank you also to all of our founding investors in this room. Without you, events like this are not possible, where we can take that St. Louis message, and we certainly thank all of the global business media outlets that joined us live this morning to hear a bit more about the thought leadership and the policy of where this country is headed, but right here from our soil in St. Louis. Finally, my thanks to Min Jung Kim and to the St. Louis Art Museum for hosting us in this extraordinary venue and bringing us together this morning in our teams. We were proud, our staff at Greater St. Louis Inc., to collaborate with the team from the Federal Reserve Bank of St. Louis and the St. Louis Art Museum. I think they did a great job. We're all trying to learn to get back together in person, probably a little rusty, so give them a round of applause as well. So that concludes our program this morning. Thank you very much. It's great to see everyone. Stay around if you'd like for a little bit and enjoy the rest of your day. Thank you very much.